Hello everyone, it's Miley here. I hope you're doing great. We just wanted to take a moment and touch base and share a little bit about what's happening in the markets right now and what it means for your portfolio. So let's break it down together. Markets have been favorable for the past few months, but November has certainly brought some interesting shifts. We've seen investors rotate out of high growth technology stocks into some more defensive income generating sectors. Now I know volatility can feel unsettling, but here's the key. The fundamentals underlying these companies in many cases remain very strong, and perspective matters. Recent price action is just one chapter in an evolving and extraordinary story shaped by inflation, interest rates, geopolitics, and of course the AI boom that's sweeping the world. Now, is this a bubble bursting or is it just getting started? The truth is that markets rarely give us the answer in real time, especially when valuations are high and so are expectations. And that's why we look at the data. And our view is that we're in a maturing bull market, well short of a bubble, especially considering that we've had a recent correction from the highs. And if the choice is, between shaking out some of the weak hands now, experiencing a bit of volatility along the way, or else facing a bigger bubble later, we'll take the former every time. Now, the stock market is down about 5% from the all-time recent highs. And drawdowns like this, are very normal. And typically, we see market corrections of at least 10% or more at least once a year. And we've seen an earlier correction in April during the tariff tantrum. Remember, staying invested through these periods is how you earn higher returns over time. Now, AI remains a powerful long-term theme. NVIDIA is a great example. This company recently beat earnings yet again, even into strong expectations. And most S&P 500 companies are reporting strong results with average profits up 15% year over year, even surprising analysts by 9%. Companies with real earnings, strong balance sheets, cash flow, and tangible AI applications are continuing to be rewarded. Even Warren Buffett made headlines earlier by investing $4.3 billion into Google, a company we own from many client portfolios, reinforcing confidence in core AI platforms. So our focus hasn't changed, focusing on quality over hype. Let's talk about central banks and interest rates. Both the Bank of Canada and the US Federal Reserve cut interest rates in late October in a shift towards more supportive policy. Here in Canada, Governor Tiff Macklem signaled a pause ahead, passing the puck to fiscal policy. Central banks typically use blunt instruments, not scalpels, so that means targeted measures will come from specific programs or private innovation for further stimulus. In the US, on the other hand, the Federal Reserve may cut interest rates again next month, and they appear to be ending what's called quantitative tightening. And what does that mean? It means that the Federal Reserve is no longer pulling cash out of the system, but may soon add liquidity. And that's a potential positive for markets. What about inflation? Canadian inflation eased to 2.2% in October, thanks to falling gas prices. Rent remains the main driver year over year, but real-time data suggests that even rents aren't declining. And if policymakers catch up, we could see more rate cuts ahead, which would be a positive for consumers and investors. Prime Minister Mark Carney recently released his first federal budget, focused on strategic investments to boost competitiveness in our economy. Yes, the deficit is large, but execution matters. Will these investments drive productivity and sustainable returns? We hope so. Some of the highlights of the budget that may be of interest to you will include 1, a productivity super deduction for manufacturing and research investments. 2, long-term capital gains exemptions of $1.25 million. 3, strengthened rules for personal trusts. And good news for luxury buyers of boats and private jets, the luxury tax is now gone. Most importantly, there's been no increase to the capital gains tax inclusion rate, a sigh of relief for many compared to back in 2024. At our recent client event, The Future of Wealth, Smart Tool, Smarter Decisions, our chief market strategist, Dr. Jim Thorne, shared powerful insights on AI and infrastructure. His monthly report has now been downloaded over 100,000 times. So let us know if you'd like a copy or check out the video on our website. One takeaway is that today's tech leaders aren't like the dot-com era. They're building on strong foundations, diversified revenues, robust cash flows, and in some cases, indispensable platforms. So this isn't just about chasing the hype. It's about investing in the infrastructure of the future. In closing, November reminded us that markets don't move in straight lines, but patience, discipline, and quality will always win over time. Your portfolio remains well-positioned, with diversified exposure to resilient sectors, income-generating assets, and long-term growth themes as well, like AI and infrastructure. Thank you for your trust in our process, and we're here to guide you through every twist and turn, with a steady hand and a clear focus on what matters most. So with that, we hope you take care, and let's talk soon.